Nilkant Mishra. Nitin Bhasin is with us now, head of institutional equities at Ambit. News just breaking also that the cabinet has approved the electronics component PLI scheme. Do we have a number? We had the management of Dixon, and we probably should get the sound bites of Dixon, which of course is the largest player in that space, almost a poster child of the electronics component manufacturing. Mobile phones, of course, 80-85% of their business, but they're, of course, fast diversifying into other areas as well. This has come through. There were some expectations that the number could be 40,000 crores. Yesterday, our colleague Ashmit reported the number actually could be about 25,000 crores. But we'll get more details as we go along. But this has now been cleared, as was widely expected. Nitin, good afternoon. Good to have you back.
Sorry. I think it is 25. I'm just going through some of the details Ashmit is putting out. I think indeed, as he was reporting, it is 25,000 crores and not the 40,000 crores that I think industry was hoping for. Some of the brokers were writing about it, but 25 seems to be the number.
Absolutely. Nitin, any thoughts on this one? And, as I said, it's widely advertised, so I'm not very sure whether anyone will make any changes to their estimates based on this. They're all probably long done. But your thoughts?
No, I'm yet to see the whole thing in detail, but clearly if they have changed the contours of the PLI from the earlier, which used to be more revenue-based, which was not leading to the right kind of investments in the component ecosystem, with this being for the component ecosystem, definitely much, much better than the earlier PLI. Companies which are focused more on creating component capabilities, we've been covering companies like Ambit for a while, and we have highlighted that capabilities around components in India need to be beefed up if we need to go out and win any market share on China Plus One or other developing markets. Quantum, I would say, is not to be that much important. I would say how and what capabilities and what global joint ventures this enables will be the key thing to watch out for, because the component technologies are with the global players. So I think PLI is one step, bringing in global partnerships. And
Nitin, you like Amber, is it in this space at Ambit?
In this space, we have covered both the stocks, but we have believed that Amber has created enough amount of component capacities, backward integrating from the AC business, now getting into defense and electronics. I think they have done a good job, I would say, relative to the other players in this space. We like their component focus.
Nitin, hi. What about the view on the markets on the whole, and what are the sectors, themes that you're recommending? We seem to have started a mode of recovery. So what would your advice be to best play that?
So we still believe that CY 2025 will be a year of moderation in which we don't see a very significant market returns. Plus minus 5% is what our view has been from the time we entered the market in this year. We continue to still think that the relative outperformance for either a wealth protection or creating alpha would be focusing more on large cap companies rather than mid caps and small caps. Yes, in the last couple of weeks, we've seen FIs come back. We've seen some bounce from the lows. It will remain a volatile market. It will remain an earnings under pressure sort of a market, which will lead to some bit of questions around liquidity also seesawing. We have seen that from the global investors. Perhaps in the next 1 or 2 months, we'll have to watch out for how the local markets, local investors also impact the direction of the market. But we continue to highlight to our global and Indian investors that it's the large caps, not the mid caps and the small caps, and stock picker market, not a very one-sided bull run. Very similar to what we've seen in the last 9 years.
Right. Hi, Nitin. Good to see you in. What about your interactions with the FI community? I recall when you joined us the last time around, you had pointed as a firm that the short positioning are at historic levels, and traditionally we see a bounce from there. And you expected flows to come back as well. What's the current feedback you're getting? The flows have improved, no doubt. The sell flows are out of the way. Now they've turned into buy flows. Do you expect this sort of a trend to continue?
I think, again, meeting a number of closer to 2 dozen long only investors in the Western Hemisphere, what you notice from them is that many of them had actually, concerned about the valuations in India. Some of them are finding some pockets of ideas to bring money back in and deploy, but some of them are also sitting on the sidelines saying that stock prices may have correct, but the valuations have still more room for downside. And perhaps their concerns around the valuations stems from the earnings estimates or the outlook of consumption or the outlook for capex in India, or perhaps even one was to add the outlook around the global economy as well. The kind of volatility in the world trade could come through because of the tariffs from the US, perhaps. So hence you are seeing some sort of excitement, discerning nature coming back to India from the global investors, but not all of them turning overly bullish, perhaps what they were about 12 months or 18 months back.
Okay, all right. Nitin, hi, good to have you on the show this afternoon. So let's talk about the current portfolio construction. I mean, given the visibility that we have, global, we don't know how things play out, but local, I mean, I think there's a better sense of the recovery now. So given that, what is the portfolio construct? What would be the top 3 overweights and the segments that you are very clearly avoiding?
So, we maintained that this year we will be looking at it as a stock pickers market. But at the same point in time, it's the mega caps, the large cap names we would prefer or advise to the investors to be overweight on. Even within the Nifty or top 100, stick to companies which are more heavier weights. We are seeing the earnings of the heavier weights holding up much better, not witnessing that sort of downgrades. What we see in the smaller to mid weights, either in Nifty or Nifty 100 or even beyond that. Number 2, banks. Clearly, banks, if you look at the last 3 months or 6 months, they have outperformed the market marginally. But that has been our view that banks is where the earning support is. If you look at FY26, large part of our earnings are going to be coming from either A banks or global cyclicals. Banks, we are confident, but not so much on the global cyclicals. We very well are also highlighting that the banks could be growing anything between 12 to 14% of credit growth. So banks would be the other one. About a month or 2 back when we had met last, our view was IT not to be in. But we highlighted now that given the correction that we've seen in IT, perhaps an underweight should be more weight to equal weights. And FMCG would be a more tactical 3 to 4 months sort of a call in which we could see positive returns in the next quarter. We've seen for technical reasons, for flow reasons, for news reasons in the last 10, 15, 20 years that FMCG, especially rural markets, are also holding up slightly better. FMCG does very good in the first quarter of the calendar year relatively. So hence, I would say a tactical call for FMCG for the next 3 months.
Got that. Nitin, thank you very much for joining in. You enjoy your long weekend. That's the call from Ambit. From being underweight tech, perhaps it's now time to be neutral tech and a tactically bullish on